Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is President and CEO of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
Unbelievable. Tax season is over. I'm alive. I survived it. It's good stuff.
Good. I know, because you were so incredibly busy. We've been talking about that from one week to the next, if you will, and it was just an overload of people coming in with different questions about tax planning.
Oh, you know what? I've said this before, and now I really believe it. If you're taking tax advice, tax planning advice during tax season, it's just a major mistake, a massive mistake. Listen, we're working 15-hour days. Yeah. This last year, the reason this year is so bad is because for the last 2 years, we've had an extra month to file taxes. So we had to get the same amount of taxes done in, with a third less time. So we're a month shorter in time, got the same amount of taxes done. It was a nightmare. So, wow. These are people that are working 15-hour days, 6 days a week. It's tough, and I'm glad it's over.
Oh, absolutely. Well, I'm glad that you're here this morning and you're bright-eyed and bushy-tailed.
Let's go.
Absolutely. Well, let's talk a little bit about what is happening in the markets right now, Stewart. What's going on?
Well, the stock market is incredibly volatile. We're getting a lot of people concerned about selling because they're waiting for it to come back to where it was. And I have a graphic, an S&P 500 graphic I want to put up on the screen. It's our most up-to-date graphic here. If you take a look, the market is still relatively high. We're plus or minus a few percentage points from where it was. We've seen some downturn, but it's obviously gotten better here. Yeah. Right before the show, I'm having clients that are in their 401ks that are calling me, hey, should I sell? Should I sell? Should I sell? And the reality is that, we don't have a crystal ball. I don't know exactly where the market's going. Anyone who pretends to is just fooling you. There's so many pressures moving the markets up and down. What I would tell people is that with this crazy environment, you've got to remember, we've had the best decade in market history here. Sometimes you have to think about taking chips off the table. And quite honestly, with the crazy market volatility, look at how much your money's grown over the last decade, 12 years or so. Sometimes you got to know when to hold them and know when to fold them, and now just may be that time.
Do you want to sing the Kenny Rogers song?
Man,
that might be fun.
Well, I was in Vegas here for, speaking to a bunch of financial advisors, kind of teaching them the way that we do stuff at Asset Preservation. And I'll tell you, it was a rough week in Vegas because that's what Vegas will do to you. But you know what? I actually, for the first time ever, walked away with the same amount of money I showed up there with. I didn't win anything from them, and they didn't win anything from me. So
there you go.
I knew when to hold them.
Absolutely. Well, I have to ask you, what about interest rates right now, Stewart? How is that impacting everything?
Yeah, it's a great question. I mean, for years people wondered whether the Federal Reserve was pressured politically, and from the time of Alan Greenspan, people used to parse every single word that he would say to see, hey, are they going to raise interest rates or lower them? And then we kind of, witnessed the politicization, if that's even a word here, of the Federal Reserve here. Of course, Trump hammered the Federal Reserve to keep, interest rates low. We're seeing the same sort of, pressures now. But now the Fed has no choice but to raise interest rates. And what that's going to do is really present some issues, for a couple things. Number one, in terms of the stock market, it makes money more expensive to borrow. So these companies that are leveraged or that need to be leveraged to grow their companies are going to have to pay more money to borrow money. That's number one. In the bond market, remember, as interest rates rise, bond values typically drop if it happens over a quick period of time. So it presents issues for bond markets. So, put it into perspective. If you're buying a 10-year bond and your 10-year bond is paying 3%, but next year they're offering bonds at 6%, who's going to buy your 3% bond if you want to sell it, right? Well, somebody will buy it, but they're just not going to give you par value, what you paid for it. They're going to give you less because, if they can get an interest rate currently that pays twice as much as what yours does, yours just will lose value. And that's essentially how that works. But it's also going to add some real pressure. Here in the Phoenix market, we've seen this tremendous run up in housing prices. You know, you're a realtor. You handle, you know, some amazing clients in the Charlotte area, and you have this great business. And we're all hoping that this momentum continues in the real estate business as well. The only thing keeping us going here is that so many people want to leave places like California and Washington to come here to retire, and there's just not enough supply there. So when it comes to supply chain, you know, it's still affecting our housing, the ability to build houses quick enough, the ability to find labor to work on it. But, you know, I have real concerns about the housing market. So a lot of our clients that have been, you know, done a tremendous job of building, accumulating wealth, tremendous amounts of wealth by renting out properties, becoming landlords. I love that historically. The problem I have now is that we may actually see those properties drop in value because of these rising interest rates as well.
Sure, that makes sense. And then, Stewart, how does all of this tie into inflation? Because obviously that's the other big topic that people are concerned about overall.
Well, yeah, so inflation is the whole reasons we have to raise interest rates, right? The interest rate increases aren't just to be there to penalize us, they're there to slow down the economy. And we may be in this sort of stagflationary position here where, you know, we're realizing that prices are going up, and inflation, they say, is the death of democracies. You know, it happened in Rome and in several other instances. But, you know, with inflation, stuff is getting more expensive. The consumer price index came out with right around a 6%, you know, inflationary number. But truly, we believe that's way understated. We think that, you know, we're seeing 10, 11, 12% when you start looking at the cost of vehicles, the cost of fuel, the cost of real life stuff, not just these obscure economics, you know, numbers.
Sure, absolutely. And Stewart, I know we're going to take a commercial break in about a minute, but I wanted to ask you quickly, anything going on with planning for Social Security? Yeah,
I think it's a really important thing to do. You know, when we come back from break, I want to dive deeply. I'm tongue-tied. Yeah, it's Vegas. Vegas still in me here. No, but we'll dive deeply into Social Security, when you should take it, when you can take it. We'll look at all those options and be glad to help.
Well, Stewart, I know you have a very special offer to present to the viewers at home today. Let's talk about what that is and then open the phone lines.
If you have concerns about the volatility that we're seeing today, if you believe that, hey, this market has run for a long time and you have enough for retirement and don't want to put that at risk, you want to get a second opinion, all you have to do is pick up your phone, click on that QR code that's right at the bottom of your screen there, or give us a call at 833-652-7829. We're offering that complimentary portfolio review. In that review, what we're going to do is look at what kind of risks are you taking? What kind of fees are you paying? And do you have any tax implications that are hiding in the background? But you have to take action today. Give us a call. We'd be glad to take a look.
Stewart, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We know you have a lot of questions for Stewart about how to plan your perfect retirement. He has the answers for you. All you have to do is call in today. We're going to take a very short commercial break, but don't go anywhere. As Stewart mentioned, we're going to dive a little bit further into Social Security and maybe talk about a few changes that could impact you. Stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning, We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is president and founder of Asset Preservation Tax and Retirement Services. Stewart, should I tell the viewing audience that during the commercial break you were actually singing The Gambler? Should we talk about that?
I tried, but this voice is shot here, so yeah,
Okay,
no, it's,
we'll
you know,
skip that.
I did go to performing arts school my whole life, and absolutely mediocre at everything, so.
I don't believe that. But let's talk a little bit about Social Security in this segment. Obviously, a lot of people in the viewing audience may have some questions about Social Security. Any changes that you see in the future?
Well, yeah, absolutely. I mean, the first thing I would first say is we need to understand the facts about Social Security, and people make tons of mistakes when it comes to that. First of all, the earliest you can file is 62, and the latest you can file is 70. But there is one moving part in there that a lot of people don't really track, and it's called your full retirement age. That is your age that floats. It started off at 65 and it's moving up to 67. So for most of you, your full retirement age is probably 66 in 6 months, 66 in 10 months, somewhere in that range now. And so Congress has basically delayed full retirement age. And the reason that's important is people mostly realize that you can file at 62. And so I use this example all the time where, you know, what happens is people, they end up retiring, they quit their job, they wait until 62 so they can file for Social Security, they quit. And then just like what happened with my dad, where, you know, my dad basically, you know, my mom was giving him grief about, hey, you need to be at home more, you don't need to work so hard. Well, then he quits and files for Social Security, and all he does all day is watch, you know, reruns of Bonanza and every other, you know, rerun, you know, these Westerns and stuff. And my mom's like, oh God, this guy needs to get out of the house. But here's the problem. Once you filed for Social Security, you know, you can only make up to right around, you know, $17,000, $18,000 a year. And for every $2 you exceed that income, there's a $1 reduction in your benefit in the form of a penalty. So oftentimes, when you file at 62, it's a mistake, because what if you decide to go back to work before full retirement age, right? Because remember, if you took it at 62, you're getting, you know, 70 to 75% of your benefit by taking the early reduction, the actuarial reduction, and then now you're going to pay all these penalties as well.
Wow.
So why would you do that? To pay these double penalties? It's just a really big mistake. So just consider, you know, whether or not it makes sense to file before full retirement age, which for you is, you know, 66 to 67, somewhere in that range there. You know, it's a big mistake.
Sure, that makes sense. Stuart, I should ask you, if someone turns it on too early, do they get a redo?
Well, you know, technically no, unless you're within the first year. So after the first year, there's something called deeming, and after a full year, you're technically deemed, which means you cannot reverse it. Now, historically, you've been able to pay it all back and, you know, undo it, but it's a really lengthy process. If you do it between 2 different tax years, it gets complicated. You generally, you know, want to try to avoid any of those major changes there.
All right, sounds good. And then also the big question everyone is asking is it going to go away? What are your thoughts on that, Stuart?
Well, you know, the question of Social Security going away is that kind of ageless, timeless question. You know, everyone knows about the issues with the Social Security Trust Fund, that it's kind of commingled into the general fund at this point. But, you know, at the end of the day, I always used to say that, you know, the seniors are the biggest voting bloc in America. No one's ever going to touch your Social Security because, you know, it always becomes a president presidential election issue, doesn't it? Yeah, but remember in 2015 under President Obama, we saw some of the biggest slashing of Social Security we've ever seen, and nobody said anything about it. You know, they got rid of the file and restrict, the file and suspend options, which they said was only for wealthy, you know, people. Is not true, but what those options did was allow you to take spousal benefits before taking your own in different combinations and so forth. So when I said, hey, and I used to do these big workshops on Social Security, we'd have 150, 175 people in a room, and you know, pre-COVID, of course, and we'd tell people, listen, no one's ever going to touch Social Security. You're the biggest voting bloc, and then they did. They took it away. So everything's on the table. Don't take anything for granted. You need to make plans as if you're not going to have it, but you know, we believe that it's not in jeopardy. We think it'll continue.
Wow. And Stewart, I have to ask you, obviously you mentioned file and restrict, file and suspend. Big changes. Why wasn't there more of an uproar?
Well, I think, you know, the reality is that most media is pretty left-leaning, and you know, whether you like it or not, and because it happened under the Obama administration, it just happened in the middle of the night. It was one of those late night signings that happened on a Friday. It was a really weird timing. So I don't know, you know, I think because the way it was positioned that it only affected the wealthy, you know, it just isn't accurate. It's just not true. You know, we did this seminar, and I remember when it was right after the bill passed, and one of the guys that was at our workshop realized, oh my gosh, I'm 2 weeks too young to get this. Like literally lost it, right?
Wow.
Lost his benefit. If he would have been 2 weeks older, you know, he would have qualified for the file and suspend option, which ended up costing him like $600,000 in benefit over his life. So I think it's really important to make sure you understand that these benefits, you can't take them for granted, but we need to plan around them. And you know, the other thing people don't plan for is the taxes regarding Social Security, right?
Yes.
Yeah, a lot of people don't realize that Social Security was never meant to be a revenue source for taxation, but believe it or not, it was Ronald Reagan that made it taxable for the first time in 1983. And what they look at to determine whether it's taxable or not is what they call provisional income. Now that word's only used in one instance, and that is to determine the taxation for Social Security. And what provisional income is basically all of your income from wages, earnings, any sort of interest income from banks or dividends or capital gains, plus 50% of Social Security benefit. If you add all that up, that plus 50% of Social Security benefit, that is your provisional income. Now the threshold for taxation is right around $32,000 for married couples. Now that number was set, you know, back in the 80s. So there's been no cost of living adjustment for any of these. The $25,000 number set for individuals was set back in 1983. So that $25,000 threshold is like $67,000 today after today's cost of living adjustment. So more and more people are being taxed in Social Security. They just need to make sure that they have a plan for it.
Well, Stewart, I know you have a very special offer to present to the viewers at home today. Let's talk about what that is before we reopen the phone lines.
Absolutely. What we're offering the audience today is a complimentary portfolio review. And what we'll do is we'll take a look. If you're trying to decide when to take Social Security, we'll take a look at that. We'll give you some input as to what we believe makes sense for you, and we'll give you some options. But what we'll also do is take a look at what kind of risks are you taking. Is it time to start taking some risk off the table, out of your 401ks, out of your IRAs? You know, what kind of fees are you paying? Are you dealing with a fiduciary? All you have to do is take action today. Pick up your phone, click on that QR code in the bottom of the screen there. That'll take you to our website, apsitaxes.com, where you can click on the complimentary portfolio review. Or even easier, give us a call at 833-652-7829, and we'd be glad to give you a second opinion on your portfolio.
Stewart, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We know you have a lot of questions for Stewart about how to plan your perfect retirement. He has the answers for you. All you have to do is call in today, 833-652-7829. We're going to take a very short commercial break, but don't go anywhere. When we come back, I'm going to talk to Stewart about how you can be more efficient. So please stay tuned.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is President and CEO of Asset Preservation Tax and Retirement Services. Stewart, before we went to the commercial break, I talked a little bit about how people can become more efficient, if you will. I want to tie that into one stream exactly, if we could, pensions. How do those two go hand in hand?
Well, you know what, pensions are going the way of the dodo bird, but thank goodness locally we have some great companies that still have them. Honeywell, for example, Boeing, for example. And a lot of times we're seeing people that, you know, are taking advice from their buddies at the water cooler as to what choices they should make. And I think that's a tremendous mistake. I think first and foremost, people have to understand what are their real options. What are all of the options, not just the ones their friends say that they should take. For example, if you work at Honeywell and you started with Allied Signal, your pension is different than some of the other ones that are offered there. It all depends on the acquisition of which company you work for and so forth. It all depends on the original contract. So for some of them, if you take your pension at 62, for example, it'll be a certain dollar amount. If you delay it, it actually accrues and grows with a cost of living adjustment, so to speak, over time. Well, there's other pensions at that same company that don't accrue anything at all. Whether you take it at 62 or 66 or 70, you're going to receive the same exact dollar amount. So why wouldn't you take it earlier?
Sure.
Right? Because no matter how efficient I am, no matter how good I am at creating tax efficiencies, I can never make up for the money you didn't take if there's no additional benefit for delaying. Does that make sense?
It does make sense.
You know, the other thing is, a lot of times people wonder, hey, should I do a single annuity for myself, a lifetime payout, or should I make it a joint payout for my spouse and I? There's different instances of where people have made the right decision and the wrong decision. For example, we have a client that he was a police officer in Toledo, Ohio, and he was this just really healthy, strong man. Love this guy to death. Phenomenal guy. He lived in Portobello. His name was Ray. He was an amazing guy. And his wife, wasn't quite as healthy as he is. Because he worked out every day, he did all that. So when he took his pension, he took the single life payout. Well, literally 2 years after he retires, he gets diagnosed with Lou Gehrig's disease, and he wastes away and dies, and leaves his wife there without any pension at all because he thought he was going to outlive her. I just tell you this, Cynthia, it's really, really important to just make sure you have a plan because he bet everything on red that he was going to live longer. And what happens when you're wrong? Right? So does it make sense to take it on a single life expectancy? It all depends on how you hedge it. Do you have life insurance to back it up if you're wrong? Maybe, maybe not. Does it make sense to take the lump sum? For a lot of people, the lump sum makes a lot of sense because they want to pass these assets to future generations. They may not have any spouse at all, or they may want to make sure that their kids are receiving some of the benefit because they've worked at the same company for 25, 30 years. And, I met this amazing man that's a flight attendant at American Airlines. And, he's one of the longest ones there. He's working on, gosh, I think it's 50 years. He's going to stay there another 2 years to get to his 50. This man's amazing. He loves his job. He loves the company. But remember, everybody, when it comes time to taking your pensions, your choices, all of these things, everyone's situation's different.
Yeah.
If you take the lump sum, well, then you have choices to be able to pass it to charities or pass it to other things, your kids if you want. You just want to make sure that you have choices. And I think before you make your decision to retire and how you take your pension, make sure you seek out professional advice. Don't just listen to your buddies at the water cooler. Really have people play out the cash flow scenario for the rest of your life.
Sure, that makes sense. Because, Stewart, I have to ask you, if someone does take the lump sum option, is there a risk that that's going to change the tax bracket that they're in, or what does that look like?
Yeah, so no, it's an amazing question. I mean, what it is, whenever you take the lump sum, you're not just taking a lump sum, you're generally rolling it over into an IRA. Now, there's some benefits and downsides to doing that, but from a tax perspective, it's tax neutral until you actually take possession of the money yourself. So no, what it does do is it actually adds a ton more flexibility, because if you're in a payout scenario and you're taking a pension, you can't stop that payout. It's just continual. And what if it pushes you into a higher bracket, or if it makes your Social Security taxable?
Yeah.
Right? With a direct single life annuity or a joint life annuity, there's not much you can do to stop that income from a tax planning perspective. Whereas if it's in an IRA, once you roll it using the lump sum option, some people do it with their thrift savings plan as well. What they do is they roll it to an IRA, and then they have the ability to convert it to Roth to really start doing some advanced tax planning. And I think that's really where we specialize, is telling people whether or not we think it makes sense in their condition, in their situation or not. But people just need to make sure that they have a plan and that they're dealing with a fiduciary.
Yes. Yes, that's so important, Stewart. With only a minute and a half left of the show this week, any final words of wisdom and advice you want to give to the viewers at home?
Yeah, you know what? The one piece of advice, now that, it's starting to warm up here and we're leaving, golf season here, stop taking advice from people in the golf course. Because what happens is these people start drinking and telling stories. And, I had a client that came to me and said, hey, you know what? Joe told me he made 28% last year and I only made 22. How come I'm not getting the good stuff? Well, they're both in the same portfolios. They made identical amounts. The water cooler talk, the golf talk, talk nonsense golfing. Don't talk financial stuff, because honestly, oftentimes people are just, talking to talk. And a lot of times it's an exaggeration.
Stewart, thank you so much for another amazing episode this week. To the viewers at home, we'd like to thank you specifically for spending time with us today. That number to call is 833-652-7829. We know you have a lot of questions for Stewart about how to plan your perfect retirement. He has the answers for you. All you have to do is call in 833-652-7829. Be safe, be happy, be blessed, and we look forward to seeing you back here 1 week from today. Take care.